Okay, so let's start our class. So again, you're welcome to another class on strategic business reporting. Today, we should round up on IFRS 15 on revenue from contracts with customers. We started it last week, but we could not finish up. At least we went a little far. And what we looked at last week, we started with the core principle of IFRS 15, looking at the objective of this standard. And we said that this standard is here to ensure that the revenue that is recognized in the POL, in the statement of profit or loss, it must depict the consideration expected from the transfer of promised goods or services. And I told you very clearly that what this means is that the revenue you put in your books must mean that you have actually delivered the goods. That what you are expecting is just money. When you put 100,000 in your statement of profit or loss, it means that you have done the work. You're just expecting money, or probably you have collected the money. So what we want to see as revenue should be the consideration you're expecting from the transfer of promised goods or services. Now, to recognize and measure revenue, we say we use a 5-step model. There's the step 1 that talks about the contract with the customer. There has to be a contract. There's a step 2. We need to be able to identify the separate performance obligation. There's the step 3, which talks about the transaction price. And there's the step 4 that says you might have to allocate transaction price to the separate performance obligation. And there's the step 5 that says you should recognize revenue when performance obligation are satisfied or is satisfied. We're able to look at step 1 to 3 last week. For the step 1, before you can say a contract is a contract, before a contract can be allowed in IFRS 15, it must have these 6 criteria that I gave you. And these 6 criteria, it is very important that you know them because they can ask you in the exam. You will see when we look at some questions. So we mentioned all of those criteria last week, and we looked at 2 scenarios that we analyzed of contracts that is valid and contract that is not valid. We looked at all that. Then we talked about contract combination. That when you have a contract that is entered into at the same time with the same customer, we said you can combine that contract together if they meet certain criteria. If they meet certain criteria, we said if the contract are negotiated as a package with a single commercial objective, or if the price of one contract is dependent on the price of performance of another, or if the goods or services in the contract can be delivered as a single package, then combine those contracts together. And also, we then moved on to, we looked at scenarios, of course, and we analyzed it before we looked at contract modification. And we said that a contract is said to be modified when there is a change in the scope or price of that contract. And a contract modification will result in a separate contract if the following criteria are met. We said if the change in scope is because of an addition of promised goods or services, and if the change in price reflects standalone selling prices, then that modification will be seen as a separate contract. We looked at examples of those where the modification results in a separate contract and those where the modification results in adjustment of the existing contract. Went on to step 2, that you need to identify performance obligation. You need to be able to know what are the separate goods or services that I am offering. When you have a contract that qualifies based on step one, then the step two is that you will need to be able to identify that this contract, we need to be able to identify the separate performance obligation within that contract. Okay, so sorry. Now, what we discussed in step two is that when you have a contract, you need to be able to identify each goods or services that you are offering. And each goods or services that you identify as being separate, it means that they are distinct. So we identify separate performance obligation, and this, for them to be separate, they have to be distinct. So each distinct performance obligation we recognize revenue on them separately. We recognize revenue on them separately. And for this performance obligation to be distinct, it means that they must have function and distinct profit margin. And having distinct function means that the customer can benefit from the goods or services on its own or together with other items that are readily available to the customer. And distinct profit margin means that the goods or services is separately identifiable. And when we say separately identifiable, it means that goods is not dependent on another goods for you to sell. It doesn't serve as an input for a combined output. It's on its own. It's separately identifiable. So for each separately identifiable goods, that is performance obligation that are distinct, we recognize revenue for them separately. So step two talks about all that we need to be able to identify the separate performance obligation. Then we looked at examples, scenario that we analyzed one by one. We took our time that day. Then I'm not sure we started step four. I'm not sure we started step four. That talks about that we should determine, we didn't start step four. Step three, we did step three. Can you remember we did step three? That talks about determination of transaction price. And I said transaction price is the consideration that is received from the transfer of promised goods or services. And this transaction price must exclude money collected on behalf of third party, like VAT. And I said this transaction price can be fixed consideration, variable consideration, non-cash, and is also affected by time value of money. We looked at examples of each of them. The one that is variable, the one that's affected by time value of money, where we will need to discount to present value, where there is non-cash consideration. And I can remember that I gave you this one as assignment for you to attempt yourself. And that's where I'm going to start from today, by solving these assignments. Then we'll quickly go to step 4 and step 5. Now, this assignment I gave you, it says we should calculate revenue of Mayfair, that Mayfair would recognize in quarter ended 31st March and quarter ended 31st June. So what's the question talking about? It says that Mayfair supplies laptop computers on 1st of January, and Mayfair entered into a contract with a customer under which the customer was to purchase laptops at 500 naira per unit. The contract states that if the customer purchases more than 500 laptops in a year, the price per unit is reduced retrospectively to 450 naira per unit. Yeah, this is the main thing. They said the contract states that if the customer purchases more than 500 laptops per year, the unit price reduces to 450 naira per unit. This means that ordinarily this guy sells the laptop for 500 naira. But we are saying that if any customer is able to buy more than 500 laptops in a year, that all the goods, all the laptops that customer has bought, we will recalculate it for him at 450 naira. If he has any change, we'll give it back to him. If he has overpaid, we'll give it back to him. So that's what they say, that the price per unit is reduced retrospectively. So even the ones he has paid for and he has paid 500 naira for, we will return the money to him because we would assume that we sold it to him at 450 naira. And that's what this is saying. So in March, the customer bought 70 laptops from Mayfair. Mayfair therefore estimated that the customer purchases would not exceed 500 as of December, and the customer would therefore not be entitled to the volume discount. So this is straightforward for the one of March, because they said how much revenue are we going to recognize for quarter-ended March. So for this quarter, revenue is simply, since the customer only bought 70, and we have estimated that based on the information we have as of March, it cannot exceed 500. Cannot exceed 500. So the revenue is the number of units he bought, 70 laptops, multiplied by 500 naira per laptop, and that's 35,000. That's the revenue we recognize. The second quarter ended 31st June 2017, which is the B part. They said during the quarter ended 30th June 2017, the customer rapidly expanded rapidly as a result of a substantial acquisition and purchased additional 250 laptop from Mayfair. Mayfair then estimated that the customer purchases would estimate the threshold for the volume discount as of December. So this particular part is saying that as of June, this customer bought additional 250. And on that basis, we estimated that this guy will exceed the 500, will exceed the threshold, and he will be able to get that discount. That is, all the goods, we are going to be selling it to him at 450 naira. So first is this, the revenue we recognize first on the additional goods he's buying. We recognize he's buying additional, how much? 250. Remember, we are going to sell that one at 250 laptops. We'll sell that at 450 naira to him. Whatever you get, we'll now deduct the discount. The 70 he has bought before, the 70 laptops he has bought that we sold to him at 500, we'll assume that we are selling to him at 450. So we'll need to remove 15 naira for him. We need to remove 15 naira and return that 15 naira back to the guy. So, and that's 3,500. While the 250 laptops is how much? 250 times 450. 112,500. By the time you remove these discounts, the revenue you recognize in this quarter, how much?
It's 409,000 naira.
That would be 109,000 revenue would be recognized. And that's the solution to this assignment. Did any of you get it right? Did you get it, Charity?
Yeah, I got the first one, but I don't get the second one.
Hello, sir.
Wait. Yes, Emmanuel.
Good afternoon, sir.
Hello, good afternoon.
I wanted asking, though it's not part of the question, but let's say in the real scenario, after passing these entries in the middle of the year, and then for certain reasons, it still did not meet the quota as at 31st December 2017. So are we going to be saying that the discounts we given will be removed again, passing the necessary entries as at 31st December? Let's say it stopped at this total of 320 total laptops he bought in June for the second quarter total. But by December, he didn't buy additional one anymore, or he didn't meet the 500 quota expected. So I don't know if you get my question.
I get your question very well. You reverse it in real life.
Okay, thank you, sir.
You reverse it, yeah. Good question. We have to reverse it and recognize all those ones we have recognized at 450. We'll recognize it back at 500 if it doesn't meet up. That's just
Okay.
that's how that has to happen.
Hello, sir.
Yes, mommy.
Yeah, good afternoon, sir.
Hello,
So
mommy.
when I attempted this question, because addition of both the 250 and 70 is not up to the 450. So how can we then assume that the person would meet up and then start recognizing at 450?
Abio, don't mind them. It was the question, no? And we have to follow what the question tells us. I mean, the question told us that in June, because he bought additional 250, they said Mayfair then estimated that the customer purchases would exceed the threshold for volume discount. So that means
So you just assume.
yes. So since they told us in the question, I mean, you have to follow like that. Since the question told you that he will meet it, then that means you have to sell it to him at 450 now.
Okay, sir.
Yeah. Now, you see, step 4 is where you allocate the transaction price to the separate performance obligation. You see, where this step 4 is only applicable where an entity sells where an entity sell goods as a bundle, okay, that it can also sell unbundled. You know that it is possible that you can just bundle some services together. Like, let's say you sell an asset to somebody, let's say a generator. You now also tell the person that you help him service his generator for 1 year. You now told the person that let's do a total package of 1 million. Ordinarily, if I want to sell the generator, is 800, but because I'm going to be doing maintenance for you as well. Let's do everything at 1 million. So that's bundled goods or services. And these services, ordinarily, you sell them unbundled, meaning you actually sell them separately. So where an entity sell goods as a bundle, that it can also sell unbundled. You see, a revenue. So even though they are selling it bundled, though, but revenue should be recognized separately. Revenue should be recognized for each separate performance obligation. So even though you are selling generator maintenance 1 million, fine. you collect 1 million. But that 1 million, you need to share it between the generator and the maintenance. You need to show it that there are different revenue line. Don't bundle it in your books. Yes, you sold it unbundled, fine. But when you are recognizing revenue in your books, recognize that revenue for each separate performance obligation. And you see, the amount received, the amount then received for the bundled good,
No, please, oh no.
charity.
No.
The amount received for the bundled goods should be allocated to the separate performance obligation based on their standalone selling prices. Based on their standalone selling prices. So you are going to allocate that money you received. You're going to share it based in a proportion of their standalone selling prices. So you will get this when I show you examples. So let's look at scenarios for this allocation. So a company sells a package for 10,000, and this package includes software license and 1 year technical support. Their standalone selling price for these services, that means if they want to sell them separately, software, they will sell it for 8,000. 1 year support, they will sell it for 2,000. So if I were to analyze this, so revenue will be recognized separately, will be recognized for each separate performance obligation based on their what? On their standalone selling prices. So we will recognize revenue of 8,000 for the software license and 2,000 for the 1 year license, for the 1 year support. We would separate it. We need to see them separately. Another scenario is that a gym sells 1 year membership for 1,200, bundled with personal training sessions, that is ordinarily 300 naira. He now sold it as a total package of 1,200 instead of 1,500 if sold separately. He says, since we are doing a total package, is 1,200. So the standalone selling prices of those goods, membership, if you are selling membership separately, is 1,200. If you are selling personal training separately, is 300. The total standalone selling price, this SSP standalone selling price, is 150. Now, again, if I want to analyze this, you will say that revenue will be recognized for each separate performance obligation based on their standalone selling price. Now, how much revenue are you going to recognize for membership? How much revenue are you going to recognize for personal training? Considering that this guy only collected the standalone price, consider that he only collected 1,200. So the standalone price for membership is 1,200. The standalone price for personal training is 300. Ordinarily, the total standalone price as given to us is 1,500. So it is on this basis that you are going to share the 1,200. So you will do 1,200 divided by 1,500. It gives you What percentage is that?
80%.
80%. And if you do 300 divided by 1/5, I guess that should be 20%.
20%.
Yeah. So the revenue you recognize for the membership will simply be 80% times the amount you collected, which is 1/2. Whatever you get, the revenue you recognize for personal training is 20% times the money you received, collected. So how much would that give you?
960 for membership.
960 for membership, and for personal training,
240.
40.
240. And this is how you are going to share that 1,200. So even though he's saying he is selling as a package, but yes, fine, you can sell it as a package, but ordinarily you sell those goods separately. Then we expect that you are going to recognize revenue on them separately. And the basis of sharing the money you received or collected will be based on their standalone selling prices, which was why we did this analysis here, because these are their standalone selling prices. We used it to get a proportion, this 80%, this 20%. On the basis of this proportion derived, then we're able to then allocate the money you received for the bundled goods to each separate performance obligation. Let's look at another one. If you look at this one, says that a company sells a bundle for 500,000, and this bundle includes a software license. The standalone selling price of that software license is known for at 40,000. Then it will do training. We don't know the standalone selling price of that. So what do we do for this now? Again, the same explanation is that revenue will be recognized for each separate performance obligation based on their standalone selling price. See, since the money you received is 50,000, we know the standalone selling price of the software. So for the software, we will recognize 40,000. We don't know the standalone selling price of the customized training. Since he has received a total of 50,000 as a bundle, we need to recognize, since they are separate performance obligation, we sell them separately. Then you need to recognize revenue on them separately. The software recognized 40K. Then we can assume that the balance can be recognized for customized training. Okay, so the whole idea in step 4 is just to ensure that each performance obligation recognize revenue on them separately based on their standalone selling prices. If you look at this and another scenario, this one talks about a network service company. This one, they gives customers free handsets when they sign a 2-year contract for network service. The handset standalone selling price is 200 naira, and the contract is for 40 naira per month. Then how should we recognize revenue here? So you see, that means that ordinarily this handset that they said they gave for free, they sell it separately for 200 naira. But I mean, for whatever reason, they bundled that service and say that if you sign up a network deal at 40 naira per month, we will give you free handsets. For you, when you want to recognize revenue, your revenue will be recognized for each separate Hey, Charity, you are disturbing our class. Why are you unmuting yourself? I will mute you, you unmute yourself. I will move you. Revenue will be recognized for each of the separate performance obligations separately based on their standalone selling price. So the assets and the network service. For the assets, the standalone selling price, let me see SSP, standalone selling price. For the answer is 200. For the network is 40 naira per month, 24. Who can quickly work that out for me? What's 40 times 24?
960.
That's 960. What's the addition of the two?
It is 1,160.
1,160. Then the proportion, this will be 200 over 1,160. What does that give us?
17%.
17%.
24%.
Approximately 18%.
Okay, just better to
No,
approximate.
No.
How is it 18?
No.
it's
17.2.
4%.
17%.
Approximately 18%.
Like approximately.
We don't have any problem with approximating in reporting. Is in FM, SFM that they will say you need to be doing point something. We can round up like that or round down. It's okay for us as accountants. So the revenue that you recognize for the assets will be 17% times what? Who can tell me? How much is this guy receiving from this deal?
960.
Thank you. That's the money they are collecting. That's what we are sharing. And 83% times 960. So how much revenue is he recognizing for each of them?
163 for the first one.
How about the second one?
796.8. 797.
979.
797.
That'll be 797.
Okay. And that's it for this question. And the last one is recognize revenue when performance obligation is satisfied. So this step 5 is saying is where you can actually put it in your books. Even all this revenue we are computing here, you only recognize it in your books when you have satisfied the performance obligation, when you have delivered the performance obligation. So, and you see, a performance obligation can either be satisfied at a point in time or over time. So for performance obligation, satisfied over time, the revenue will be recognized either based on the cost incurred to date, or based on performance target or performance achieved. So I can call this output method. The standard didn't call it that. I'm just giving it my own name. If you are looking at based on your output or you using the input method. So like our school now, equity professionals, for those of you that have paid fully, you know that we cannot recognize the full amount as revenue because the performance obligation is satisfied over time. So for us now, we can easily use output method because we know that the lecture is for 4 months. And at the end of 4 months, we'll recognize revenue. So now that we are already in the end of the 2nd month, we just do 2/4 times total money that we have collected so far. That's the amount that we can recognize as revenue. So let's say we have collected 100,000 and we recognize 50,000 as revenue. Which account are we going to take the balance to? Anyone?
Sir, I think it will be accrual because it has not been, you have received it in advance.
Okay.
No.
What do you call it?
Contract obligation.
Thank you, Foma. It's called a contract liability. At least there's somebody here that remembers what we have been teaching like that. It's called a contract liability.
I am not in class last week, sir. So, I've not gone through it. So I'm just saying from experience, sir.
Okay. And so I trust you. I know that if you're in class, you will have remembered also. So it's a contract liability. It's a contract liability, not accrual. Accrual is very different from that. It's very different from that. They are not the same. Okay, so I think it's better we use scenarios to explain how we recognize revenue over time. But for performance obligation, satisfied at a point in time. So the revenue will be recognized when the entity transfers control of the goods or services to the customer. Transfers control of the goods or services to the customer. So even though they might not ask you this in the exam, but when control is said to be transferred to a customer, control is said to be transferred to the customer where the customer has legal title over the goods. The customer has physical possession of the goods. The seller Now the seller has rights to receive its consideration. The seller has right to receive its considerations and more. So all of this indicates that that control has been transferred. Now let's look at these scenarios to demonstrate all of this. Now, scenario one, it says a company provides a cloud-based accounting software, subscription for 12,000 per annum, cloud-based accounting software subscription for 12,000 per year. The customer pays annually in advance. Okay. So this is a performance obligation that is satisfied over time. And in this case, the company will recognize revenue of 1,000 naira, which is 12,000 divided by 12 months. You will recognize that per month. So this company, it collects subscription for 12 years for 12,000 per year, and the customer pays annually in advance. So the amount of revenue this company can recognize per month is 1,000. So you see, the full journal entry will look like this. You might not be required to do this in the exam, and you might. So you see, when the customer pays, we'll simply debit bank with that 12,000 that we collect, and we'll credit contract liability with that 12,000. So at the end of each month, when we offer the service, we simply debit the contract liability with how much we are recognizing per month,
which is the expense.
and we credit 1,000. So this is what you do every month, like that. Emmanuel, I'm with you.
So is there anything like on unearned revenue? Though I know it's also like the same thing as contract liability, but that term, because I want to know so that before I will experience it from my head.
Yes, please. Take it away from your head. There's nothing like that in IFRS 15. In fact, what
Thank
people used to call it is deferred income.
Okay.
That's the common one. But there's really nothing like that. Don't call it that. Call it contract liability.
Or deferred income, right?
Don't call it deferred income. There's nothing like that in IFRS 15. What we have in
Okay.
IFRS 15 is contract liability.
Okay. Okay.
Yeah.
Thank you.
You're welcome. Okay. Scenario 2. A company sells an apartment unit for 500,000. The customer takes ownership, makes payment, and has no further involvement from the developer. So what happens to this? So this is a performance obligation satisfied at a point in time. Okay, because I sold an apartment for 500. So the customer takes ownership, makes payment, and has no further. So the entity will recognize revenue of 500,000 as soon as control of the property is transferred to the customer. So as soon as we transfer control to the customer, we'll recognize revenue because it's at a point in time. Another one is a company sells an apartment under construction. The customer pays in installment and has legal ownership as the construction continues. So for this now, this is a performance obligation satisfied over time. So here now, revenue can either be recognized using input method or output method, depending, by looking at how much have we incurred to date over the total costs, or looking at the performance. If you have done 80% of the project or 20%, every month you should be able to know how either of them is fine, but revenue is recognized as you progress on a monthly basis. And that's the hallmark of revenue recognition. Any questions before I move to some practical scenarios, some practical transactions, and see how we recognize revenue on each of them? Okay, I think we should look at those ones. The first one is sales and right of return. Sales and right of return. Now, you see, from the name, so this is where an entity sells goods to a customer, but the customer has the right to return the goods within a defined period of time. Within a defined period of time. You see, you see, revenue cannot be recognized for the goods that the customer has the right to return. That the customer has the right to return until that period elapses. So what we are saying here is that when you tell a customer, you sold goods to a customer, and you tell the customer that, you can return these goods within 3 months. That means within that 3 months, you cannot recognize revenue. You cannot. So the consideration received from the customer will be recognized as a refund liability as follows. So that means we're going to debit bank and credit refund liability with the amount of the goods. If you're very good with double entry, you will see that there is something, there will be a gap somewhere with this. Because if you are not recognizing revenue here, and you have already sold the goods, We have delivered the goods. But the only reason we are not recognizing revenue here is because we have agreed with the customer that he can return. Then there will be a gap. Because remember that, let me put it that way. Remember that since the entity has delivered the goods, it will have recognized cost of sales. It will have recognized cost of sales on those goods. Because we will have recognized it as part of our goods purchased. It will be there as cost of sales. But because we cannot recognize as revenue, IFRS 15 says that we have not actually transferred control because this customer can return it. Then, therefore, we will need to remove it in cost of sales also. Therefore, we will derecognize the cost of sales in respect of the goods by transferring it to where? By transferring it to an asset. What do we call it? Because we'll be expecting him to return the goods back. That's an asset to us. We can you can call it goods recoverable accounts. You can call it any name. We don't really care about the name we call it. So you don't just debit bank and credit refund liability. You would also need to remove it from, we debit a goods recoverable account and we'll remove it from cost of sales. Just so that you are not understating your gross profit because you have not recognized the revenue. So don't recognize cost of sales either. So remove it from cost of sales, just put it as an asset. So if the customer returns the good, if the customer returns the good, then fine, we'll give him back his money. We'll credit bank and we'll close out that refund liability account. And that goods recoverable account, you can close it out to inventory. So the goods recoverable accounts can be closed out to inventory. So you just take it back to inventory at the end of the year. You would remove it from your book. However, if the customer does not return the goods, then the refund liability should be closed to revenue by you debit the refund liability, then you credit revenue. You transfer it to revenue, while the goods recoverable accounts will be closed back to cost of sales. And everything ends there. Okay? So this is how it works in real life, in your exams and all of that. This is the sequence for sales and right of return. First, for the period under which the customer can return the goods, we simply debit bank and credit a refund liability account. Then, and I said that remember that you know that we have delivered these goods, so we'll have recognized cost of sales on those goods. So we need to recognize that cost of sales in respect of these goods by transferring it to an asset called goods recoverable account. So we'll credit it away from cost of sales. Otherwise, you'll be overstating your gross profit for that period. You'll be understating it, I mean. Now, if within that period the customer returns the goods, then we need to pay him back and close out the refund liability. The goods recoverable account can be taken away, close that account and take it to inventory. Then it's like we have collected back our goods. But if it doesn't return and that period lapse, right, then just close the refund liability to revenue, goods recoverable account, close it out cost of sales, and everything ends there. Now, all of these hypothetical examples, let me just put a figures to them. So a company sells 1,000 units of goods at 10,000 naira per unit, making 10 million in total. The cost of goods is 6,000 naira per unit. Now, the company estimates that 5% will be returned. Now, for this one now, so the entity cannot recognize revenue for the goods that the customer has rights to what? To return. So the revenue that can be recognized, is to the extent of that 95%, right? So our revenue is simply 95% times what?
1,000, 10,000.
Times 10 million, and that's 9.5 million. The balance will be recognized to a refund liability account, which is that 5% that is returnable. And that's how much?
500.
500,000. You know, these two, they are credits. The remaining debit is bank. We have received money, but let me just leave debit and credit alone. The cost of sales will also be recognized. Will also be derecognized and transferred to goods recoverable accounts. So since the cost of sales is 6,000 naira, so the cost of sales will derecognize is 1,000 units times 6,000 times 5%. How much is that? Is that 300,000? So we just debit.
Yes, 300,000.
Okay, debit goods recoverable accounts with 300,000. We take it away from our cost of sales with the same 300,000. So all of this, this scenario I'm painting, I can conveniently ask you, and just keep it simple. And the principle is very simple. If a customer can return goods, you see that period within which you can return, or the proportion you can return, don't recognize it as revenue. Recognize it as refund liability. And don't forget to also recognize the related cost of sales and take it to a good recoverable account. That's it. That's it. Another practical one that you can find in your exam is warranties. Warranties. So,
They never come back, sha.
better mute. Warranties. So now, for warranties, okay, so there can be a standard warranty that is usually embedded with a product. This is usually given to give the customer assurance that the product will perform based on agreed upon standard or specification. So there are some standard warranty that comes with the product, where that one is just telling the customer that we assure you that this product will work well. So revenue are not recognized for this warranty because they are not sold separately to the customer. They are not sold separately to the customer. So it's not like the customer pays for the warranty. No, the customer does not pay. So, but rather, the entity must recognize a provision for this warranty in line with IAS 37. However, there are warranties that are sold separately to a customer for additional services. I think Apple does it a lot on their phones. There are some, they will tell you that, okay, this product comes with 1 year insurance. After 1 year, if you still need this insurance, you would pay money. Those are extended warranty. Those ones they are now selling it. They are selling it separately to the customer, right? So these types of warranty are separate performance obligation. And revenue should be recognized separately for them. And revenue should be recognized separately on them. Those are for the extended warranty or additional warranties that are sold separately to the customer. And an example is if you look, they said Premier Co sells a machine to a customer for 196,000, which is the standalone selling price of the machine. The sales contracts includes a warranty that provides assurance that the machine complies with agreed upon specifications and will operate as promised for 1 year from the date of purchase. As the customer represents a new business to Premier Co., it also offered an additional extended warranty at no extra cost, which guarantees the machine will operate as expected for a further 6 months, 6-month period after the standard warranty has elapsed. 6-month extended warranty are normally charged at 4,000 naira. Okay, so this one, the standard warranty, that gives assurance to the customer that the products will perform based on agreed upon specifications will be recognized as a provision in line with IAS 37. So we need to make a provision for that. However, the extended warranty has a standalone selling price, and the entity usually sell it separately to customers. Though it is given to the customer free, but it is a separate performance obligation, and revenue must be recognized for each separate performance obligation. Okay, so the amount received, how much was the amount received? 196,000 will be allocated to each performance obligation based on their standalone selling prices. So the performance obligations are the machine and the extended warranty. The SSP, the standalone selling price for the machine is 196,000. The standalone selling price for the warranty is 4,000. The total standalone selling price is 200,000. The proportion for recognition, this will take 196 divided by 200. How much is that? And this will take 4 divided by 200. What's the percentage? Anybody?
Is 0.98
0.98 for 196/200, which is
the first one.
98%.
And the
So,
second, okay.
so the revenue recognized for this will be 98% times how much?
Times 196. That 196.
196,000. Why this would be 2% times what? Times
4,000.
196. So what do we have?
It is,
One
it
nine
is, it,
zero eight zero.
say the first 192.80 naira. 192 is 080, the first one. Okay, the second one,
3,920.
3,920.
And that's the end of this question. Any questions?
Hello, sir. Please, I'm lost somewhere.
Where?
Hello, sir.
Yeah, I'm with you. IFRS.
Please, yes, sir. Please, this chart here where you said SSP, this silent selling price of 196 and 4,000, I didn't really get the rationale behind this particular computation, sir.
Okay. By just coming to class, or you have been here before?
I'm at work, so I got distracted. I just came back fully now.
Okay, I just want to be sure so that I would know whether it's something you don't understand or you were not around when we explained it. Okay, now I get. So what we're trying to do is that the money we received is actually 196,000, but since there are more than one service here, we sold machine and we are giving extended warranty, which ordinarily we sell. Even if we are giving it for free, fine, it's okay, you can give it for free. It's like we are selling the bundle at 196 and we are giving this extended warranty for free. It's okay. But IFRS 15 requires that you still have to recognize revenue on that item because it's a separate performance obligation. You need to recognize revenue on them based on their standalone selling prices, which is why we established their standalone selling prices. That normally we sell the machine for 196, we sell the extended warranty for 4,000. So we then do a proportion. As you can see, 196 divided by 200, 4 like that. So on the basis of this proportion is how we're going to share the money is receiving to each of the separate performance obligation. So the revenue recognized for machine is 192,080, and the one we recognize for extended warranty is 3,920, based on their standalone selling price. So that's what we're going to recognize for each of them. That's how it works. So we had looked at it before anyway, for those that were aware. Now, another practical scenario is principal versus agents. Okay, so it's important that when you're selling goods and services, you need to know whether you are acting as a principal or you are acting as an agent. Because if an entity is acting as a principal, the revenue recognized is equivalent to the gross amount received. Is equivalent to the gross amount received if you are acting as an agent. Meaning is the owner of the goods or services, is the provider of the goods or services. So a principal is the party that satisfies the performance obligation. But an agent only facilitates the performance obligation in whatever way, but he's not the one satisfying it, but he's in the middle. He facilitates the performance obligation. And the revenue recognized is equivalent to the commission received for its facilitation efforts. An entity is acting as an agent.
Sorry, sir. Facilitation what?
Efforts. For its facilitation efforts. So an entity is acting as an agent. An entity is acting as an agent if it does not have inventory risk, that is, any loss of the goods does not recourse to him. So if the inventory should get lost or spoiled in the warehouse, it is none of his business. And if he does not have credit risk, that is, if the customer does not pay, the agents will not suffer the loss for the amount unpaid. So majorly, these two can guide you on whether somebody is acting as an agent or a principal. If the person does not pay, it's not you they are owing. If it's the other party that will suffer, then that means you're an agent, because you just collect your commission and move on. The worst you can lose is your commission, not the money the customer wants to pay. Or if anything happens to the goods and you are not going to lose, it does not come to you, you don't have any recourse. It does not recourse to you. Also, it does not establish prices. For the goods or services. Is the seller, is the owner of the goods that establish. If you don't establish price, it's just you are just facilitating through whether you have a technology platform, whether you have some relationship, you know people, you're just a middleman. So it's people that would, how much you want to sell? You can add your own and be smart about it, but you are not the one establishing prices. So, and of course, he's not the one that is going to satisfy the performance obligation. He's not the one that is going to get the actual work done. He's the main person that's getting the actual work done. Then you should know that that party is acting as an agent. Now, an example is this. So an entity operates a website that enables customers to purchase goods from a range of suppliers. The suppliers deliver directly to the customers who have paid in advance, and the entity receives a commission of 10% of the sales price. The entity's website also possesses payment from the customer to the supplier. It processes payments from customer to the supplier at prices set by the supplier. The entity has no further obligation to the customer after arranging the product to be supplied. Is the entity a principal or an agent? So the entity is an agent because from what I can see here, the entity only gets commission number two. The customer pays directly to the supplier. Number three, the entity bears no inventory risk. As you can see, he has no further obligation after arranging the product. And the prices are set by the supplier. So he's acting as an agent in this case. Any questions? Principal versus agents. Now, another one is repurchase agreement. So a repurchase agreement is where an entity sells goods and agrees with the buyer to purchase it at a later date. So the issue here is whether the sale qualifies as a sale in line with IFRS 15 or whether it is a financing arrangement and the entity use the asset sold as a collateral.
I think it's a refinancing agreement.
What does that even mean?
Financing a rearrangement, rather.
Okay.
Sir.
Sir,
Because it meets the 5 steps of IFRS 15.
Okay. Any other question?
yes, sir. I think the issue here is whether the seller should recognize it as a revenue since the seller agrees to buy the goods at a later date.
This can
Okay.
be recognized as revenue. It's more or less an agreement, but not revenue.
And
Okay.
we can liken it to like a redeemable preference share or something. The issue here is whether the sale qualifies as a sale in line or whether it is a financing arrangement. As in, I just try to think as in outside the box, sir.
Okay. Okay.
So it's like a lease, finance lease is like financing arrangements.
Okay. All right. You're all correct. And so, I mean, you guys are thinking ahead of what I have here. So, for now, we can't really say there is any of those that you have mentioned for now because we don't have the details. So, the issue here is just the fact that when you have a repurchase agreement where somebody sells goods and is agreeing with the buyer that is still going to buy it back at a later date. So, for us, that transaction seems suspicious, and we need to look at it very well. That can you recognize that item as a sale? Because if you know you're going to buy it back, why did you then sell it initially? Or do you want to use it as a financing arrangement whereby you needed money, you just sold the person collects money, and then later when you pay back, you collect back your assets. Maybe that's what is happening. So we need to dig deeper. And that's what this is just saying that, okay, let's dig deeper. That is it really a sale or is it a financing arrangement? So please give us more details. So you see, more details can be into three. So your purchase agreements can be any of these, three. Number one is where the seller has an obligation to buy it back, or let me simply call it to repurchase. That we call forward contracts, where he has an obligation. So you know that when we say he has an obligation to repurchase, meaning that he must buy it back. He must buy it back. When we say somebody has an obligation, meaning you cannot avoid it. That's what obligation means in conceptual framework. You cannot avoid, you must buy it back. So we call that forward contract, meaning you have entered into a forward with that person that you would execute, that you buy it back. We call that forward contract. Second one is that where the seller has the right to repurchase. So where the seller has the right to repurchase, in that he is now left to his own volition, his own wish, whether he wants to repurchase or not. Nobody is forcing him. If he repurchases, fine. If he does not repurchase, fine. We call that call option. If he repurchase, fine. If he doesn't repurchase, fine. Another one is that where the buyer has a right to sell it back to the seller. How can I put it in a more simple way? Okay, where the seller must repurchase if requested by the buyer. Is better. So where the seller must repurchase it if requested by the buyer. So if the buyer says, come and buy it, come and buy it back, come and repurchase. He must repurchase it. We call that put option. Now, these three, you can ask it in the exam, see them. So, is these three that now dictate how we treat it? These repurchase arrangements. Let me quickly summarize it for you.
Excuse me, sir.
Yes, Emmanuel.
Yes, sir. This scenario, forward contracts, call option, a put option. I understand the explanation, but I'm just wondering what type of interests do firms tend to have before reaching this type of agreement?
It varies, really. We don't know, seriously. Which is why this is becoming a little, we are trying to cover all angles. We don't know. So, some people, it could be that they want to get a loan and they just want to shield the transaction to look like a sale. Instead of them to come out and say, okay, we want to get a loan, we don't have money. That okay, give me money, take these assets. When I get back the asset from you, then I will return your money back. Or probably maybe they want to just treat it as they want to lease out that assets. Maybe they intend to lease it out. Instead of them to come straight that there is a lease, they will just shield it as if it's a sale and agreeing to repurchase back. So we really do not know because people do it for a variety of reasons. Some people come out honestly that it is actually a repurchase, that they actually want to sell, and they are actually repurchasing it because they might need it. Some is okay, while some they are just trying to shield and trying to create accounting. So which is why we are now digging deeper. So with these three now, we know that we are going to ultimately get you. We will get your intentions and we would ensure that you report it faithfully and fairly. Okay. Yeah, mommy.
The explanation on that put option is quite confusing to me because I know that for a put option, it is a right to sell an asset. So if you are saying the seller must repurchase if requested by the buyer, I don't know, it's like there's a kind of contradiction there. If he must repurchase, that means that sounds like an obligation, not even a right. And it is a right to sell an asset. So I don't know if I'm mixing something up.
Right to the buyer.
Where the buyer has rights to sell the assets. If you all agree with her that this is simpler for you, then fine. Is what I've written is the same thing as this. But if you understand it that way, then I'm happy.
This is pretty straightforward. We don't go confuse
Thank
us
you.
again. Thank you, sir.
Look, this one is straightforward, though, but something is hidden there.
Okay.
That first one is better. Something is hidden because it's not that open. It's vague in one kind.
Exactly.
Because
So
when you say the seller must repurchase on the request of the buyer, it's open. But as it is now,
exactly.
when you just say the buyer has a right to sell, it's not maybe go as requesting the seller or not requesting the seller.
You get it now.
That's how I
You
look
get
at
it
it.
very well. So yeah, I agree with you, Christopher. So she is using the knowledge she has from SFM and all of that. So I just like to keep things simple. If this is simpler, it's okay. It doesn't affect anything, right? But for reporting, the way we put it explicitly, unfortunately, she's not getting it as that is the same thing as saying the buyer has the right to sell. and don't see put option as that he will sell. He might not exercise the selling. So he will always sell if he wants to. But at any point where he wants to sell, the seller must, meaning that the person that sold the asset to him initially must come and buy it. So which
That's
is the
it.
same with this one, that where the seller must repurchase
Mhm.
if it is what? If it is requested
If read by the buyer.
by the buyer, is just the same thing as what Omomi also said, that where the buyer has right to sell the asset. Just that this is just the way it works. The way I've expressed it here is how it works. That, okay, the person that sold the asset must repurchase it if requested by the buyer. Meaning that if the buyer does not request, nothing will happen. But if the
Yeah,
buyer
that's it.
requests, exactly.
Yeah.
If the buyer requests, then you have to. So either one is okay for me for your exams. So in your exams, we really just need you to have an idea. I've not seen ICANN exam going deep, very deep into all of these things, but you just need to have an idea like that, that okay, this was happening, that's what's happening like that for each of these on the face of it. So either one is okay for me. So before our time is up, because I'll be stopping in 10 minutes. Oh, 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 oh God. I'll be able to have plenty questions for us to solve. Plenty. Okay, no problem. I'll continue next week. So where the seller has an obligation to repurchase. So now the issue here is this. We are saying that we sold, okay, the seller sells, he sold goods, and we are saying he has an obligation to repurchase, meaning that he must repurchase. Nobody, I mean, at a specific date, he must buy it back. They have already agreed it. So, yeah, there is a substantive agreement between the entity, that is the seller, and the buyer, that the seller must repurchase the assets within a defined period. Within a defined period. Now, please, two scenarios here. If the repurchase price is higher than the original selling price, this will be treated as a financing arrangement, where the original selling price or the amount received by the by the seller, will be treated as a liability, and the repurchase price will be treated as a repayment of the loan. So the excess of the purchase price over the original selling price is treated as an interest payable on the loan. So this helps me to always never forget this one, that you're repurchasing it at a price higher than the original selling price, the amount you sold it. Then we'll treat it as a financing arrangement. Because why would you be repurchasing an old asset that somebody will have used? You're not paying more for it. The only interpretation we're giving to that is that that original selling price, that original money, that original price you sold it is a liability, a loan. And the repurchase price is a repayment of the loan. So the amount, the excess of that purchase price over the amount you sold it initially is interest. That's why you're buying it extra, because you're paying interest on the loan. So I saw Samuel's hand. Samuel, you have a question. I said Samuel. Emmanuel.
Yes, sir. So I understand this scenario, but my problem now is since you are giving a physical asset, this is just not a naira flow now. The physical asset here is an inventory. So I'm just a
So,
little confused about the treatment of the inventory part
so the
regarding this
asset,
particular.
so the assets will still remain in the books of the seller. It will not be derecognized. So I mean, we are saying it is not a sale. That's what we are saying here. That you did not sell, that you only borrowed money. So it's a good
Okay.
question I've asked, Manuel. Yeah. Nothing is happening, nothing is changing, the assets will remain, the inventory remains.
Hmm.
Nothing is going to touch that. Because for us, you did not sell. You did not sell.
Okay.
But yeah, but if the purchase price is lower than the original selling price, this will be treated as a normal sale transaction.
Hmm.
Okay. And the repurchase of the assets is seen as an acquisition of a new asset at the agreed price. And that's it for this one. And that's it for this. So there are examples here. Every scenario I'm going to mention, like there are examples for the forward contract here. This one I've given you now, I would put figures to everything. I have example one, example two for you. For the put option two, example one, example two, example three. And for the last one, which is where he has right to sell and all of that, I have another example for you there as well. So yeah, this is already 4:57. If I start, I won't finish, and I don't want to use the time of my FR students. So I will continue this. I will finish up this on Wednesday, and I'm going to be starting uh, either I will do IFRS 16 leases I'll do IFRS 16 leases on Wednesday. I'll start it and I'll finish it over the weekend with you guys. Then after leases, let's just go to group accounts like that. Group account is 7 classes, but I think you have learned a lot of standard. You have learned a lot of standard, then that group account becomes meaningful to you. The principle of group account itself, it will not take me 3 classes to explain it to you. It's straightforward. But the way I can test group account now is different from the way they test it before. Now they need you to know the standards so well that consolidation now is just adding 2 companies' figures together. So they won't start all those consolidation adjustments will just be very little here and there and all of that. So we're going to be starting group account immediately after leases. You know that I took 30 minutes out of your time. So for that reason, we have IAS 10 event after the reporting date. And I already told you that we'll be having Sunday classes now because I'll be busy with case study from ending of September on Sundays because I'll be starting the 7 weeks intensive class for case study students all over Nigeria. So you guys inclusive. So I'll be very busy from ending of September up until your exam. Every Sunday case study. So I want to use these 4 weeks. Let's take advantage of that Sunday classes. So tomorrow, after your case study, Mr. Ali will be taking you guys case study. I'm not sure we'll be doing SFM tomorrow. So it'll be case study. After your case study from 8 to 10. So let us do 10 to 12. Let's look at IS 10 on events after the reporting date. Then when we then come back on Wednesday, we'll come and finish this one and start IFRS 16, which we are going to finish the next weekend. Then we'll double into group account. So that means we are finishing group account in September as well. Then we come back to, before I even come back to all those other standards, I'll first of all teach you ratio. I'll teach you earnings per share. I'll teach you sustainability reporting framework like that. So after we are done that, what we are going to have left is just very minimal, like IFRS 8 operating segments, like IAS 34 interim financial reporting, and maybe IAS 24 on related party transaction. And I also need to revise, which I will do in one of these Sundays. I need to revise some standards with you that you have forgotten, like PPE. I need to remind you on how to calculate depreciation, like IS 38. I need to remind you, like borrowing costs. We need to revise it, like investment property, government grant. You need to know all of these standards. The examiner, ICANN can ask any of them. You need to have an idea of them. So I would also be revising those standards with you in September, and all of that will be done. So we have a lot of work to do in September. So by October, I want us to have just scanty things here and there, not anything serious again. So which is why we are doing a lot of hard work at the moment. So let's ensure that you are available for tomorrow's class from 10 to 12 for us to look at IS 10. Okay, so thank you very much. See you tomorrow at 10 a.m. Bye bye.